There's a saying that I have: you'll either learn through your losses or you'll learn through education, but either way, you're going to pay for it.
Hey guys, it's Matt Haycox here, and we are recording another lockdown podcast. We're recording today on Friday the 8th of May, so bank holiday May. So you have to excuse me for being sat here with my glass of wine a little bit early in the day, but even I'm allowed to relax now and again. And I've got with me Samuel Leach, who is the founder and director of Samuel Co Trading. Sam's also an entrepreneur, TEDx speaker and investor. And inspired by his own personal journey, Samuel established Samuel & Co in 2012, really to provide an opportunity to those with a desire to succeed in the financial trading industry, but may have not had access to it otherwise. Prior to that, he worked in a private bank, and he excels in tech solutions. And in 54 countries, over 1,500 people have graduated from his trading course. He operates out of the UK, also has an office in Madrid, has his own podcast, a fantastically successful YouTube channel as well. So it's a pleasure to have him here. Samuel, thanks a lot for joining us, buddy.
Yeah, thanks. I love it. Looking forward to seeing what route we go down. Yeah, really excited.
Well, listen, obviously I've given a brief introduction to yourself, but do you want to flesh that out a little bit more? Tell us really how your journey started and what inspired you to be where you are today.
Yeah, where to start? So started off back at college. 29 now, so going back quite a few years. And when I was at college, I just looked up highest paid jobs, and at the time it was either working on an oil rig or working in the financial markets. And I applied to work on every single kind of oil rig job that I could get, but it was 5 years experience, 10 years experience, all of this, and no one was biting on it. So I went for the next best thing and managed to secure myself working in the leading independent private bank in the UK, and that's Hoare Co Private Bank, and they're based on Fleet Street. Used to be opposite Coutts until Coutts moved, but had a great time in that bank. Really kind of got to know everyone there, and it really opened my eyes to the markets, what wealth management team were doing, what they were getting involved with, and I felt like I was really missing out. And all at this time, I was still doing my final year at university. So, I ended up using my student loan to trade, which I don't advise. Obviously, for a young guy at the time, it was just something that it was a bursary. So I was giving it for free to go to my local university. And so that's what I did. I traded on low risk, started buying off with stocks, and ended up doing really well. And then eventually phased out and moved away from the private bank when my kind of monthly salary was overtaken by my trading profits on a 2 weekly basis. So I knew that it was the right decision to make at the time. And when I moved away, I just had a large demand of individuals. At that time, it was a good place to be, with helping individuals learn more about the financial markets and how to take advantage of it. And if not, just to learn a little bit more about how their money works with interest rates, APRs, things like that, and moving into that kind of field. And we just, hit the ground running. There was a lot of people that wanted to see what we was doing, work with us. And ever since then, we've just completely excelled and continue to do so today. And now it's, developed into multiple companies and diversifying across lots of different asset classes.
What were your personal trading strategies when you first started, and what had given you the knowledge to be able to do that? I mean, were these things you were learning from the bank and effectively applying with your own money, or were you developing your own strategies and learning back then also?
Yeah, great question. So when I first started, I was losing money left, right, and centre, and I mean virtual money at the time, because my background, I didn't come from money. So I just used to sit there and I would trade on paper. So I'd say I'd buy here, I'd buy there. Later on, there's a different story when you actually get involved with the emotional side of actually winning and losing money. But so I would take that as as how I started at college, because I just wanted to see what I could have done. And then it kind of really started to develop whilst I was at the bank. And that was, I started to see the concept of how the individuals were trading. And it was all done on a short-term period. You're talking 30 to 50 trades a week they were closing, a pound against the US dollar. and they were all very small, quick wins. And you're talking about a big private bank here, and some of the trades were 4 grand, some of them were 40 grand, but there was nothing ever really in the 6-figure basis. There was in, there was out of the market. So I spent pretty much 2-3 years of my life and 18 hours a day just sitting there, working out exactly how I want to proceed with this. And I then went and back tested my system all the way back to 1970, and because you can download the data and pre-run it all. And it took me a while, a lot of nights of not sleeping. And I think I still got the panda eyes today in the natural kind of industry that I'm in. And it took years of practice to be able to get to that stage where I'm profitable. And I think the big concept of what is profitable and what is consistent is a big kind of fog, I would say, of what people deem as that. And that's probably, I'd say, 8 months profitable out of 12 months. So there are months where you will naturally lose when the cycle and the market changes, or when there's market shocks like the pandemic.
Tell me, you mentioned obviously that you used to trade with virtual money, before you started using real money. Do you find like a different level of discipline, needed to train with that? Like I play poker, for example, and if sometimes I'll play on the sites or in mates games where you are literally playing with virtual money or chocolate buttons or whatever it is, and I find it so hard to discipline my mindset to make the right decisions that I would have made if that was real money. I mean, do you find it hard in that training environment?
It's exactly the same. I mean, let's put it this way: when you're trading with, when you're playing poker with virtual money, how much more likely are you to go all in? Yeah, there's
you're always calling an extra hand.
Yeah, and that's exactly the same mentality. And I think that's why when you transition into trading, I found it really hard when I first started with £2,000. I was risking £20 a trade. So from day one, I would always risk just 1%. And I remember just getting super excited and scared with the fact that I've got £20 on this trade. And back then I was trading stuff like Tate and Lyle, the sugar company in the stock market, and hoping to make £40 on my money using leverage. And it's this kind of approach where I was so scared doing that, and it was a completely different aspect to trading virtual. And that's just something that you can't really practice for it. You just have to be in that environment and start off with a very low amount of money and start incrementing it. And in the day and age that we're in now, you can get away with putting on trades as low as kind of 10 pence, so it's a nice way to kind of feed your way into it, and not having to risk a lot of capital at the same time.
I mean, you said earlier on that when you move from virtual money, you move to real money, and you describe yourself as losing money left, right, and centre. And I mean, my day job is I'm a lender. I lend in the SME space, property bridging, etc. And I've been lending in one form or another for 15 years. And I always say that you only ever learn when things go wrong, and you can only learn from losing money. And as hard as that is. I really almost can't think of another way around it, because you can take the advice of other people, and I'll always say, if I'm trying to help someone, if I'm trying to mentor someone, I say, look, I've made the mistakes so that you don't have to. But it's still very, very difficult to you still want to go off and do your own things, don't you? And I think did you find that your learning curve took a dramatic upturn when you were risking the real money?
Yeah, so on that, I was saying that there's a way that you're entering into the markets. Same with poker, actually. You'll do one or two things. You'll either learn through your losses or you'll learn through education. But either way, you're going to pay for it. That's how I've always seen it. And yeah, I agree. You're definitely there's a barrier of how much you can learn when you go from theory to practice. Just again, like playing poker. But yeah, it's one of those that as it excels, it carries on going. And now, when I look back, I've been doing it for 10 years now. It's just it's boring. We had unemployment figures come out just a little while ago at 1/2 out of the US, and watching pound dollar fall through the floor at the moment. And it's when you start seeing that kind of things, it doesn't faze me anymore. But to a new trader that watches that, they're panicking, and they haven't seen it before. And it's an interesting thing to say that over the last 10 years, there's not much that I haven't seen. I was involved with the double dip recession through 2011, 2010, and moving on, we saw the gold market collapse. We've even seen oil go negative, which is the first that I've never seen. I saw the Chinese markets collapse prior to the pandemic. the trade wars. There's not many things that we haven't seen in the market now that can kind of scare me. But if you're coming to the market and you're fresh to this, you don't know what those expectations are, what they can see. And I think, for me in my trading career, the biggest kind of scariest thing that I've ever seen was the depegging of the Swiss franc. And when I saw that, it was just falling through the floor, and I didn't know what to do, and I couldn't take advantage of it. So I was just watching it. And so you can only become seasoned to these things as time goes on,
I'd like to talk about some general principles as well, because for anyone listening to this, for anyone watching this, you may not have an interest now in FX. You may have one in the future, but even if you don't, I mean, look, Samuel and I were talking a little bit offline before we came on. You were talking about thick principles like preserving capital, diversification, etc. I think whether or not you ever have any intention to trade whatsoever, the principles that someone like Samuel will use to run his business and run his financial life are completely portable, to any kind of money industry, to any kind of money thinking. So I think for any of you listening to this now, don't switch off, just because you may not have an interest in the FX, because I think what we're about to talk about now is going to be a fantastic grounding for you all in general. But Sam, I mean, what do you think some of your sort of your key principles, if you had to advise someone with money management and financial growth, would be?
Yeah, I mean, let's just put it out there. I trade FX. Is it the only thing that I trade? No way. And I want to just look at it from a statistic point of view, you see a lot of advertisement out there. Get involved in the FX, the most liquid market in the world. It's a great marketing ploy, 100%, great marketing ploy. The real facts behind these figures are that 95%, roughly, you see on brokerage websites, 95%, I would say, of retail traders lose money. So that's usually over a 5-month window. You'll find that brokerages are promoting and saying 80% of their clients lose money. So it kind of gives you the factor. You're basically saying if you're in a room of 10 people, there's only 2 of you that are making money. That's not an odd that you want in your favor at all. But if you looked at, say, an S&P Vanguard fund, which is an ETF, and you looked at over a 20-year average, 99.9% you've made money. Now, the difference between the two is one is aggressive, and you see the marketing to flip your money as quick as you can. And the other one is slow. You're 20 years, I'm going to be older, and so on and so forth, and you're not that interested in it. The truth of the matter is, if you can't preserve your capital and work with it on a basic level, you can't go full aggressive. It's like taking, someone that wants to get into boxing, and your first step is to go to the gym and probably get on the running machine or get a skipping rope out. It's not to then go against Anthony Joshua next week and expect that you're going to come out on the right side, because there's a very, very small chance that you're ever going to do that. And that's the premises of it. And I always think about, we need to preserve what we have, we need to diversify what we have, and we need to do that in the smallest, most simple way that we can. Now, before interest rates changed, you could have got involved with like Monzo, smart banking, 1%, and it doesn't sound like a lot, but your money's sat in your bank. Now, if your money was just sat in there and you was gaining 1%, it would pay for a meal out, or it would pay for something, where you're making 20 or 30 pounds. And it's taking that small kind of steps. If you look at premium bonds isn't a massive returning factor, but it's about, on average, is about 1.8, 1.5% per annum. It's 100% protected. There's no downside risk. And you've also got the chance of being that one lucky person that can get the £1 million ticket or something smaller, So it's about easing into this as a category, rather than saying, I want to just trade FX. I hate being labeled as just an FX trader, because it's definitely not what I am. I actually started off as a stock trader, and I still trade stocks. The way that I trade now is I trade long-term stocks. And this is big companies. We're talking blue chip companies. And this is the bulk of my portfolio. And then I'll trade intraday, in and out, trade in the FX markets, and fully diversify that, whilst I've got what I call like my smart banking, my low risk investments, my bonds, my premium bonds, ETFs, and things like that. And I think there's a big misconception about being able to make money in the financial markets, I say in general, because it doesn't, again, just involve FX. When I talk to my students, we have probably about 5 or 6 different ETF funds that we could all go and get through Hargreaves Lansdown. And at the end of the 12 months, if you was to diversify across the 5 or 6 of them, you're looking at 9 out of 10 times you're going to be making between 10 and 20% per annum, which is a lot more than what you would get in the bank. It's just been sat there. And this is managed by billion plus funds. These guys know what they're doing. They've been in the game for a long time, and you can start off nice and slow.
I mean, it's very interesting what you say, and I'm almost embarrassed to say that some of these concepts are something that I'd only really properly got my head around over the last kind of 2, 3, 4 years. And I say embarrassed, as for someone who spends every day dealing with business and dealing with money, you often do sometimes forget the basics. And the book that was actually a turning point for me in all this, which again for anyone watching or listening to this, you've got to put up there as, for me, one of the all-time, it will become as much of a classic as a Rich Dad Poor Dad or a Think and Grow Rich in a Time, is Tony Robbins' Money Master the Game. Do you know it, Sam?
You know what? I've got that book, but I haven't read it yet. Am I right in saying that's the one that's like,
right?
It's really
that's that, right? Honestly,
yeah.
And obviously, in a way, you might think, well, I can't be bothered to read it because you know so much in that space anyway. And it's kind of almost how I felt when I was going to read it as well. But because it does really go back to the basics. But what Tony Robbins is an absolute master at is taking complicated concepts and really distilling them down for the layman. And what he's done in simple, I mean, I'm very oversimplifying what is something like an 800-page tome here, but what he's basically done, he's gone and picked, I forget the number, let's say 20 or 50 of like the world's best wealth managers. Yeah. And we've got people in all different spectrums. So from, let's say, a conservative, like let's say, arguably conservative person like Warren Buffett, who buys and holds, for like his entire life, through to people like, Jack Vogel, from Vanguard, and other names that escape me. All from aggressive traders to day traders to conservative to people who like who like currency, whatever that may be. And he's taken all of the principles and distilled them. But then even these people in very different spaces, what they all ultimately say is that well, you've mentioned 95% of retail traders losing money. I think they almost go as far as to say that 95%, if not more, of professional traders actually lose money. And when you start to layer onto that, the fees and and the inflation and this, that, and the other, the actual stat of anyone being able to beat the market. Either if you're a non-professional, of you being able to beat the market is as good as impossible. And if you are backing most, let's say, professional traders, whose only focus is on churning and taking the fees, that you're probably still behind the market. And that's when I basically, obviously not about compound interest, etc., but that's when I really hit home the power of like tracker funds in the right tax wrapper with compound interest over a period of time. And my view is I spend my day-to-day life doing very aggressive, risky things. Maybe not. I don't feel risky because I understand that space in the same way you don't feel what you do is risky because you understand that space. But I guess for any long-term capital, it's stuff that I don't want to mess around with because I can mess around day to day. So after reading that book, I started to set up ISAs for the first time. I'm thinking at the time, I'll be 36 years old. I'm thinking in hindsight, what a fucking idiot! I've missed out on 18 years of tax-free savings. 6% might not be exciting, but 6% tax-free for 18 years is fucking unbelievable. And literally, I went off the back of that book, set my ISAs up, set them up for my daughter, because I'm thinking at the time she'll have been saying 9. I'm thinking even if I just give her $4,000 a year into a kid's ISA for 9 years at 6, 7, 8%, she's almost got a 50% deposit on a house when she goes to uni then. And it's just so simple. And I guess that's why people are interested in it, because it is so simple, because it's not exciting, because you park it and you don't have to touch it and dabble with it every day. But but the money that you can make is just phenomenal.
No, I 100% agree. And so what you've just said is pretty much what I would call like your baseline investor. That is what people, and it doesn't take much, like what you just said, and knowledge to actually have to do that, to set up the ISA. And I think we ran some stats with one of my teams. And I think it's about 55% of people below the age of 30 don't have an ISA. It's a ridiculous amount of individuals that don't have that. And that's just something that just, why don't we expand on that more in school, in education? That, we learn about all this stuff about algebra, but we don't learn about what APR is why we shouldn't get a credit card or and rack up a bill on that, should I say? Or, you know, understanding how does a house deposit work? What's the best mortgage to get? And do I go variable? Do I go fixed? You know, what is the Bank of England interest rate? How does that affect me? We don't know any of this stuff, and this is all things that, you know, I try to hit home in the first place, what I call money management, understanding and you know, reserving your capital. And it doesn't take much to utilize that. And again, if you're utilizing that and you have your day-to-day money, then especially if you've got a business and your business is growing, there's no reason why you can't have that in a business savings account whilst you've got that. And it's, you know, when you've got reasonable cash flow and it starts growing, that 1% starts adding up, and you can do more things with it rather than just sat there and going, oh, it's only 1%. But yeah, on a year-on-year basis, that adds up to things. Just like, again, multiplying your services that you can offer. If it adds on a couple of thousand here or there, and you start doing that multiple times, you have multiple revenue streams, and it's the same kind of concept.
I tell you what, I was staggered at the time as well. So I read the book, and when I put this down, I mean, literally, I read it in like 3 days, 2 or 3 days. You know, given how fat it was quite an undertaking, but it felt so easy to blast through, and I found myself, you know, like I said, almost doing Tony's PR for the book for him. Over the next few weeks, like going around to people saying, "Can you listen to this?" And I'd be talking to it, you know, with really successful people, very wealthy people, and everyone's immediate reaction is, "Well, yeah, I haven't got an ISA. I haven't got a SIP. I just can't be arsed." And I'm only then in those terms thinking, but listen, you're a mega wealthy, successful guy. Why the fuck are you saying you can't be asked with a tax wrapper? I mean, all you have to do is click ISA instead of general investment account when you're putting the money into it, and all of a sudden you've saved yourself 40% on your profits compounded. Why the fuck would you not take advantage of these super simple things? But it always comes down to excitement, doesn't it? You know, we all want to, you know, get a 10x return in 24 hours and have something exciting to tell the people in the pub about. You know, there's nothing exciting to talk about an ISA in a FTSE 100 tracker fund, but that's where the money is.
No, 100%. And what you've got to realize is the opportunities that come with that as well. So, you know, if you've been doing kind of what I've been doing since, you know, I started 10 years ago, and that's play the slow game, build up the wealth, build everything up gradually. And, you know, I wrote an article on LinkedIn called 7 Years Later, when I was waiting for the market collapse again, because there was a cycle between 7 and 10 years. And I was waiting for that. And so all I've been doing ever since then was just building cash reserves for now. And now is the most amount of time I've ever been invested into the stock market. And I'm talking, I've never been happier with having risk on at this moment in time, because I was sat there waiting for this example to happen after I saw the back of what was happening in China. And it was just prime time. Everything was perfect. And now I'm getting companies, and I'm talking top 100 companies that are 50% cheaper than where they were. And some of them, I don't want to name too many of them. One of them, if you look at BP, they got hit with an oil crisis, and they've been hit with a pandemic at the same time. And at one point, you know, first time in history we ever saw US oil actually on the contract went negative, because it costs more money to find someone to pay to hold it and store the oil than the demand to get rid of it, because everyone's off the road. Now, if you look at BP, the share price has gone down to a 20-year low. Yeah, we're talking pre-2000. Are you telling me that BP is going to disappear? It's not going anywhere. It's one, I think it was like the seventh, one of the 7th largest companies in the world. And when you're looking at that from a scale of size in the oil industry, you know, ExxonMobil, exactly the same. That is the largest US oil company, down 40%. So you have to look at this from the Warren Buffett approach here. You know, I've got a nice portfolio now of 6 to 8 stocks that are all looking to make 100% return. And that will do that maybe in 24 months, I would say. Comfortable period of time once this is all over. And, you know, we're talking about large banks. We're talking about top industry companies. And I'm just sitting there going, where's the risk? You know, some of these have got 3 billion in cash flow. They're not going anywhere. It's not an airline company, by the way. But, you know, when you're looking at it from that kind of size of things, if you was trying to go for the 10Xs, right now you might be wrapped up in deals and not have the cash available to pounce on those opportunities. And they don't come around often, once every 10 years roughly. So that's what I gear up for. So I play the slow game. This is my first major 10 year that I'm just mega excited about. it's a great time. And I think preserving your own capital, especially in times like this, when you're running a company and you have offices where you've got overheads, you've got rent, a lot of people are hitting issues right now. And if you preserve capital, you have that spare to look after everything and keep everything bolstered if you're going through hard times at the moment.
We've got a specific question from one of the viewers here on Facebook, actually, which I want to bring in from Paul Devine. And Paul says, I'm just reading this verbatim. Paul says, Bank of England are forecasting a deep recession in the UK due to COVID-19. Yet the FTSE 100 is back on the way up towards 6,000. It seems counterintuitive. Is it false sentiment, and are we due another big drop, or is the recession already priced in?
Yeah, great. I think that's a fantastic question. Obviously, we're seeing a lot of QE. We're seeing a lot of money being pumped into the markets. We're seeing a lot of messages from the government about seeing how they want to bolster the economy. There's two sides to look at this. One, we've got this whole part that we're looking at where the government is saying, look, if you're going to be furloughed and so on and so forth, you're going to be paid. And then they've got all of these business loans that are coming out, and they're saying that they're interest free. You've got mortgage gaps, you've got this, you've got that. And I've spoken to mortgage providers, and they're saying, no, it just gets added on at the end, and that interest would increase. So you're still paying for that. And then on the business loan, it's only interest free for 12 months. Now, if you think about this, there's going to be so many businesses that are taking out these business loans. And, I was looking at this beforehand, before this even happened, the pandemic happened, was when we looked at consumer credit debt, not even business, but consumer credit debt was outgrowing wage growth. Now, that's a massive concern for an economy anyway. But if we're seeing now businesses starting to take on these mass amounts of loans that are available, and they're very freely available at the moment because of the pandemic, well, most businesses in 12 months' time, are they going to be able to repay that? I don't think so. I don't think so. And again, the next thing they've done is they said, don't worry about your VAT bill. Yeah, keep the cash reserves, use your VAT. Well, I know a lot of business owners that actually, if they don't pay it, when they get the follow-up, they're like, oh God, I don't have it. I don't have that VAT. So now what do I do? But the thing is, they've extended this now for such a long period of time before they have to repay, that people are going to get hit with a VAT repayback. They're going to get hit with their business interest loans. And what does that do? If the consumer debt is high and now business debt is high, it seems natural that we are on the kind of tipping point of a recession past that point. However, that's a very kind of long-term view to see when that happens, and that could be 12 months down the line that we see that start to happen. But in regards to the FTSE and where the market is, do I believe that we're going to go back down again? I believe if there is the sign of a wave 2, which I'm still tracking at the moment in China, which is very hard because the numbers aren't very truthful out there. So the first place we have to look at is Italy. So when we see Italy coming back online and we see them start running again, and actually US is jumping ahead of the gun here by starting to reopen their states already, even though their cases are growing on a day-by-day basis in that state. I think it's on a 14-day moving average. The cases are still growing. So these are the places that we need to watch that are jumping ahead of us. Italy was already ahead with the pandemic. If we can start seeing how these guys start rebooting their economy, we're going to get a great insight into the UK, because the UK, we're actually quite slow. They said that they might be, they're giving us an update on Sunday/Monday about whether or not they're going to lift the lockdown. The rumor has it it's going to be extended all the way through now until end of May, and we won't be looking to go back until June. But even when we go back, what does that look like? And so the economy is going to be very much a slow reboot. In China, there was like no group gatherings of more than 4 people. If you was to go to a restaurant, you can't sit opposite each other. You have to sit at diagonal angles. So if you was to cough, it doesn't go across each other. This is all the stuff that we have to come forward. And if we see in either Italy or the US, in one of the states that is reopening quicker, if we see a wave 2 coming back in, we're going to see, again, another slowdown in the markets, because I don't think anyone's really factoring in a wave 2 at the moment on that side. So if that happens, then yes, we will definitely see the market drop down again. If not, we'll see a full-blown rally in the stock market, and it will go up, and it will massively go up probably for the next 6 to 12 months on a rebound until these figures start coming back out, that businesses are struggling with their loans. Credit consumer debt is probably going to be growing. I can imagine it's going to take a long time for people to feel confident now to go back into the shopping markets and supermarkets and being around mass people. I mean, I can't even imagine what people feel like who have to get on the train to London. They're all going to be wearing masks. So a lot of stuff is going to change. And I think it's dependent on a lot of factors to see if we see that drop. But I think what we'll see once the economy is back on is seen as positive news. Positive news, we're back in business, our economy is ready to boom, and you're going to see, you know, a 3 to 6 month rally on that. And then the stats of what happens to the businesses when it's starting to look to pay your VAT bills, repay your loans, and so on and so forth. It's going to be another scenario, just like the student loan, where you everyone's taking it because everyone's doing it. And, you know, when the interest starts coming in, you start going, oh, wait, hang on a minute. Why didn't I pay that back? I've got my VAT bill to pay now. I've got this. And it will cripple a lot of companies, I think.
Well, and it's almost an extension as well of a situation I've been talking about. I mean, you know, since the beginning of Corona, or since the beginning of lockdown, you know, I've been very, very much advocating for the fact that so many of the businesses complaining about about their current financial circumstances, you know, were not hit by COVID. You know, they were just businesses that were unviable before. And that they were effectively surviving from month to month, you know, scraping by the payroll, you know, because of various alternative lenders, or because banks weren't putting them under, or because, you know, creditors were allowing them to kind of, you know, continue to stretch their terms, and that ultimately, you know, these businesses, you know, were due to go bankrupt at some point. All that needed to happen was a week or two of lack of turnover or heavily diminished turnover, and they wouldn't be able to cope. And for me, that's what happened at the beginning of COVID.
Yeah.
You know, these businesses were complaining that COVID's affecting them, but the reality was they just had no support mechanism, no wool on the back. And in a way, I was almost, you know, I don't want to sound negative to, you know, to guys watching here who were suffering genuinely harsh financial circumstances. But in a way, I was almost ready to see a nice set of cleansing. You know, these businesses that should have gone long before, we've now finally got rid of them and sort the wheat from the chaff. But effectively, you know, what's happened with and yes, it's been tough for a lot of people to get these loans over the last 4, 5, 6 weeks. But now the bounce back loans out, which literally, I mean, it's like opening the fridge and taking some food out. I mean, it is that easy to get access to it. That all it's done is, okay, yes, there's some genuine cases out there of people who will use it until they're back on the feet. But all it's done for a lot of the people that I'm looking at or speaking to is just giving them another 6 months, giving them another 12 months to keep chucking along with that business that was about to go pop. And now when it goes pop, it'll just go pop with a larger amount of debt.
Yeah, no, I agree. I call them zombie companies. Those ones that are just ticking along. They've got 2 to 4 weeks cash flow left, and you know, if something was to go bad, let's have a bad month, they would have closed down. And now they're going, right now I've got that readily available capital. No, 100% agree. And and how does that look? You know, all this money's got to be repaid back somehow. You know, it's got to come from somewhere. And if not, what's going to happen to the overall general economy? And it's an interesting space at this moment. And if anything, for opportunists like myself, it's, you know, I've been looking at businesses for sale and just looking at all of them, and I'm seeing some crazy businesses and opportunities that there are. And it's, you know, I'm talking stuff that I would never have looked to venture into. I saw a cafe the other day for sale for £30,000 with 100k bottom line annual turnover, but they're shut at the moment. So clearly they're not covering their overhead. So they just thought, let's get 30 grand and sell it. And I'm just sitting there going, it's not even a 12-month return on that. That's incredible. You know, I recently just bought a security company, and the contracts that were with it were some of the biggest that I've seen. And, you know, I'm talking top A-list celebrities that are on there. And I just think this is, the opportunities are there, and it's just the fact that people that manage their businesses and their cash flow poorly, I would say, not in all cases, but in those where they're going out and they're buying they're splashing cash on a new Range Rover they didn't need, or whatever, under the business, and they're spending £50,000-60,000 that could have seen them through maybe 2 or 3 more months on their rents and so on and so forth on their overheads. And it's those kind of businesses that are really going to struggle, I think.
Well, listen, one more thing I just want to talk to you about before I'll let you wrap up and enjoy the rest of your Bank Holiday Friday, or pour over your screens more likely. One of the things that I've been seeing a lot of lately, and I'm sure the guys watching and listening to this have seen plenty as well, is so many influencers at the moment doing effectively sponsored posts for these. I'm using inverted commas for anyone who's only got the audio on. For these FX traders, and and it's always like, follow my friend Sally, she's smashing it, making a load of dough. We then, you then, out of curiosity, click on Sally's page, who hasn't got one single post that's got anything to do with FX trading whatsoever. I mean, maybe there's a couple of pictures of her in a Range Rover to try and imply she's got some money, but obviously, she doesn't seem to be doing anything to show us how she's got it. Now, common sense would dictate immediately move off onto someone else's page. But for me, the fact that so many of these people are doing these posts, for me, kind of almost says they must be working for them in some degree, in terms of actually getting people to sign up to whatever programs are selling. I mean, obviously, things like this, give a bad name to people like yourself who clearly, very much know what you're talking about, have your finger on the pulse, and and make good money, giving good advice. I mean, what's your viewpoint on that?
Yeah, it's like a knife in the back constantly, because obviously it's got to the point now where it's given the FX industry such a bad name. But FX industry, in most businesses that do importing and exports, used as a hedging business anyway. So it's fundamentally it's been used for years, but it's just this whole opportunity now of the fact that you've got individuals out there that are, and I can't talk because I'm 29, so I'm still young. Yes, I've got my kind of lockdown beard going on, but if I didn't, I'd look probably 20. But there's a lot of these 20-year-olds that are saying, look, follow my trade, so on and so forth, pay £30 a month or whatever, and you can copy what I'm doing. And my message to those people that are out there doing that and copying the trades, you've got to realize it's a very gray area between investment advice, which is a regulated activity in itself, because if you're telling them what trade to take in the market, you're touching doors with regulatory issues. But yeah, for those that are getting those kind of messages from people, the truth of the fact is you can never really copy anyone in the FX market in an effective manner. And the reason why is that if you're trading on such a quick term, you're talking, I enter the trade now, potentially in half an hour, I'm out of the trade. So let's say I sent that text to you, Matt, and said, look, go and buy this trade right now. And you don't check your phone for 5 minutes. All of a sudden, the price has moved. And that's quite a good period of time for it to move in the FX market. And you've gone and bought 5 minutes later. You've got a different price to me. It could be better. It could be worse. And then all of a sudden, an hour later, you're having your dinner or something. And I send a message saying, just closed it, get out. And you don't see that for another 45 minutes or something. The difference between time, unless you're 100% glued to your phone, you're never going to get the exact same results as the person sending you those kind of messages to say, do this or do that. The truth of the matter is that most of them are not making money, and they've got 50 to 100 people paying them the £30 a month, which is paying for them and their car finance to stay at home. That's the truth of the matter. My opinion on it, I think that it's one of the worst things that could have ever happened to this industry. And I think that the educational space in investments, and especially FX, needs to be regulated. And I think it needs to move in that direction. And there's been a lot of calls for that in the property space as well that I've seen lately over social media. But I definitely think that in the FX space, the educational side needs to be regulated, because there's a lot of people out there that are falling for this. And it's the younger generation of people that are, Instagram is a prime place for marketing. Every business is on Instagram. The reason why is because people look at a billboard for 3 seconds. The average user on Instagram is on there for 20 minutes. It makes sense. You've got the eyes of individuals and an audience. It's 100% normal to advertise and market on Instagram, but to do it in a manner where it's not really going to benefit them, and you're not really adding any kind of learning experience. I also think that the reason why it's doing so well is because people are lazy by nature, and if they can copy someone, they would, rather than learning themselves and picking up a book and really going into that information, or going through lessons online, or like on my website, where it could take you 10 hours, it could take you 20 hours to go through that information. And people don't want to do that. They want it now, and they want to do it straight away. And what they'll most likely do is go and deposit £200 to £500, and they'll go and lose that over the next 3 to 5 months. And people listening to me, they can probably resonate if they've gone and done that. And it's you'll never make money in the FX market putting £200 to £500 in. That's a fact. Yeah, you need to have extreme experience on being able to do it. You may as well take that £200 or £500 and invest in your own education, get a book, pick up a virtual account, and start learning. Because at the end of the day, what happens if you were making money and you did turn that money into something, but then all of a sudden the guy that was sending you signals plopped his clogs or something like that, something happened and he stops? Well, that revenue income is stopped for yourself. It's pointless, really, on being able to do it. So you have to look at it in a logical way. But unfortunately, because of it, a lot of people are lazy. It's something that is booming, and it's something that we combat all the time. And with my YouTube series that we just launched, the Real Forex Trader series, it's where we actually show people, okay, what does the real world of Forex look like? I can tell you now, it doesn't look like laying on a beach with a laptop with a pina colada in your hands. It's sitting in a room with loads of screens, right? You get into trading because you want to buy time in your life and have a lot more fun. But I can tell you now, when you've got positions open in the markets aren't shut in the US right now. So everyone's on a bank holiday. I'm looking at my screens over here and seeing what the markets are doing. That's the truth of it. You are glued to your screens. You're glued to your phone in regards to making sure what Trump is tweeting at all the times. And you end up with, dark eyes, and you're going to be there for a good few years. And that's the truth of the markets. And the series documents those 18 people from all different backgrounds. In this series, there's an MMA fighter, there's a construction builder, there is people that work in Mercedes as a car salesman. We took someone from every different industry, a care worker, and threw them into the markets, taught them what we knew as quick as we can in a 4-week period to see how they would experience it and what their outcome was. So they didn't pay for any of it. It's a social experiment that we do each year, and it's a good bit of entertainment, and it's something for people to watch.
Well, I can certainly echo what you were saying for anyone who still doesn't quite believe about the stressful life of a trader and the fact that it isn't it isn't sat on the beach with pina coladas. I mean, whilst I personally I'm not a trader and don't have experience of it, I have a lot of friends, spouses of friends, and even investors of mine who are traders in some way, shape, or form. Normally, most of the people I know, they work for hedge funds and they have an allocation of capital that they trade. And let me tell you, going on a holiday or going for dinner with these people is not an enjoyable experience. I mean, you need to make sure there's at least more than just you and him, if it's him, or you and her having dinner, because you won't get any fucking conversation out of them, because there's always something going on in the world that is always making them look at the phone, lose sleep, whatever that may be. And really, like Samuel's just been saying, I mean, that is what it's like. In the same way that anyone watching this who is busy or passionate, about their business in any way, shape, or form, knows that you never switch off to it. That you've always got, in the same way that if you've got kids, you've always got eyes in the back of your head of where they are. It's like that on steroids when you are a trader. So don't get sucked into this shit, guys.
That's 100% that. And I mean, when you look at the idea of what you're doing with the tracker fund, how much less stressful is that? I mean, you don't have to check it so often. You don't have to really do much of it. And that's the same with, like I said, these stocks that I've bought. Yes, it is more aggressive because I'm buying individual stocks. However, with the scenario that we're in, I believe long term, that's great. And I won't check them. I'll probably check them once a month and just see how they're doing. It's not something that I would be adjusting them. Even in a 6-month window is probably where the first point I'll be looking at even doing anything with that.
And if you do look at them, as I can say from my experience, if you do look at them and they're down, you don't lose a second sleep over it because as we all know, you only lose money when you crystallize that loss. And if you're not going to sell these, it doesn't matter. I mean, when COVID started, I actually was on my tracker accounts because I think that was the back end of ISA season, and I was sticking some new money in. So I went on and I saw what the portfolio was. And in the previous couple of weeks prior to taking a proper bashing, like, I don't know, I forget the numbers, 15, 20, 25% plus on some of the funds. And literally, I mean, I didn't even stop eating my lunch or drinking my drink because it doesn't make the blindest bit of difference to me. So if you can take that long-term view, then happy days. But yeah. Samuel, Listen, thanks for being here, buddy. I've actually been suffering social media and podcast fatigue over the last few days. I've been doing so many of these, but it's been absolutely refreshing and reinvigorating for me to have you on and have this chat, mate. It's been really interesting, and I could go on for hours and hours. And I'm sure you're someone I'd love to have back on the show at some point in the future if you can find us some time. And thanks, guys, for watching this live. And for anyone still here and for anyone listening or watching, where can we find some more of you? Just give yourself a little shout out for your social and your websites and stuff.
Yeah, sure. So my website is samuelandcotrading.com. I'm usually on YouTube and Instagram. So my YouTube, you just type in Samuel Leach on there, you'll find my channel where the series is that I was just talking about, or on Instagram, which is @Samuel Leach. And just to make it very clear, I only have one account on Instagram. It's the blue ticked one. If you get messaged by someone else, it's just a fake. That's actually it. There's so many of them out there.
Perfect. Well, listen, thanks a lot again, buddy. It's been fantastic having you here.
Thanks a lot.